rate cuts is underway with inflation data and unemployment data supporting the Fed to make the right decision. It will definitely affect the market as a whole. So in this video, we will go through why rate cuts will benefit both REITs and bank stocks regardless. A lot of people have always assumed that with the rate cuts, banks will not do well. That is not the case, and I will talk about it later in the video. First, let's talk about how things will change with rate cuts. Firstly, the most important thing is that dividend stocks and REITs becomes more attractive. Secondly, it's cheaper for companies or individuals to take on more loans or refinance their loans. And what is the bad thing when interest rate cuts? Bank savings accounts interest rate, bonds, and treasury yields will drop. This essentially means that safe yields will start dropping. This makes riskier assets such as stocks, REITs, more attractive as they give higher returns. From 2008 to 2021, interest rate has been very low for a very long time. During this period, not a lot of people talk about putting money in savings accounts, bonds, or treasury bill because the returns were not very attractive. Currently, the effective interest for the latest bond is about 2.7%. Back when interest rate was low, the lowest effective interest rate was only 1.71% for the 10 years. Back in 2019, bank savings account rates was lower compared to now at 2% range after hitting the requirements. Unlike now, where you can hit effective interest rate of 4.65% by hitting certain requirements for OCBC 360 savings account. So what can we see from this comparison? Once interest rate starts coming down, places which are safe to put and earn returns will start to look less attractive as government bonds and bank savings account rates start coming down as well. This will make it less attractive for people to put their cash in banks or bonds and look for alternatives to earn higher returns. So the next place to look at definitely will be the stock markets or REITs, as the returns provided by them will be higher. With interest rate coming down, the safe yield from different assets will drop. For those with ideal cash that wants a higher yield, Momo Cash Plus is definitely a place you can consider putting your money in. This also supports my channel by using my link. It guarantees up to 6.8% yield for the first 30 days. That is higher than some of the dividend equity in Singapore and not bad for a short-term return. These funds can also be redeemed with no lock-in periods. Existing users will also get to enjoy the promo by putting in fresh funds of at least $10,000 and maintaining it for at least 60 days. For new users to Momo, there is also a starter promo kit for you. By depositing $100 and making just one buy trade, you will get $20 cash coupon. Similarly, if you deposit $3,000 with 3 trades, you will get stock bundles worth $70 with fractional shares from stocks such as Apple, Nvidia, Tesla, AMD, or Microsoft. Making $10,000 deposit with 8 trades will get you $210. So let's start your investment journey with Momo and sign up with my link today. Let's use Mapletree Industrial Trust as an example. At the current share price, it's giving a dividend yield of 5.6%. When the interest rate cuts, rather than dropping in returns like the bonds or savings accounts, their dividend yields or return will increase. Why? Because REITs operates by taking loans, and if the interest rate comes down, their debts will become cheaper. Thus, this leads to more income for them to distribute to shareholders. This will in turn increase the dividend and thus make it more attractive to investors. On top of that, the 5.6% dividend yield will look much more attractive as compared to safe yields dropping, and thus share prices of these assets will go up as more people buy them. So that is why, if you are looking to park your assets in safe yield, it's important to lock the yield if the interest rates are going to be cut. Taking the latest bond issue as an example, this would mean that by investing any amount into this bond, you will essentially secure an effective interest rate of 2.77% for the next 10 years. This is something important to consider because as interest rate drops, offerings from safe assets such as bank savings accounts will come down very quickly. Once safe assets returns starts dropping, people will look for more other higher returns assets. And that is the main reason why equities prices will start going up, because more people will invest into equity for higher returns. Singapore, which is the country that I'm currently staying in, have lots of companies currently giving dividend yields of around 5 to 7%. If we see this formula, expected returns equals to risk-free rate plus risk yield. So if the risk-free rate such as bond returns drops due to the drop in interest rate, expected return also decrease as well. This will cause dividend yields of stocks to drop as more people start shifting around their cash for higher returns. Dividend yields is equals to annual dividends per share divided by share price. So when dividend yield drops, this means share prices are increasing, earning you capital gains as well if you are invested in them. On top of that, if you have actually bought these stocks early, you will get the current dividend yield on cost rather than lower dividends later on if you have bought it later at a higher share price. Now, I also want to address another myth that a lot of people have. When people think of interest rate cuts, they will assume that bank stocks will not do well. This is not true because banks, of course, will adapt to the interest rate cuts. Let's take DBS as a prime example. Being one of the best banks in Asia, expectations are very high for them. Knowing that interest rate cuts are expected, they have been hedging their loans. This can be seen from the drop of their net interest income sensitivity. Back in 2021, it was 18 to 20 million per basis points, but now it's just 4 million per basis points. So what this important data mean is that for every 0.01% drop in their margin, they would lose only 4 million as compared to previously when they might lose 18 to 20 million. Therefore, this meant that even if interest rate drops, it will impact them less negatively to their income. With DBS doing this, I'm sure other banks such as OCBC and UOB are actually doing the same thing as well. Moreover, people are forgetting that when interest rate drops, it's more attractive for businesses to take on loans. This meant that even though interest rate margin might drop, the amount of loans taken by public will increase. This will help to offset some of the drop in the interest income. Banks also have another part of their business, and that is the non-interest income. This non-interest income includes items such as wealth management and credit card fees. With OCBC, UOB and DBS exposure in the Asia market, I'm confident that as more money flows into Asia, these three banks will definitely benefit greatly from them. This will be another catalyst for their non-interest income to continue growing. Moreover, even with the recent share price increases, their dividend yields are still in the range of 5 to 6%. That is very attractive because unlike REITs, their dividend payout ratio is only at 50%. This meant that 50% of their incomes are kept for growth. This is why throughout the years, banks' dividend can be seen to grow over time as compared to REITs' dividends. So just because the fact that interest rates are dropping, you should not assume that banks will not do well. I feel that they will be able to maintain their dividends easily at the current payout ratio. At the current dividend yield range of 5 to 6%, it will look way more attractive when the interest rate drops. This will mean more people will buy in when it looks attractive and the share prices will go up. Thank you so much for watching. I hope this video gives you some good insights on the importance of planning for the interest rate cuts. If you find this video helpful, please support the channel by hitting the like, subscribe, and comment on what are your thoughts on the interest rate cuts. Thank you, and I'll see you in the next video.